In the short term, it's terrible. In the medium term, it's fantastic. This is the kind of inflation that we're looking for. In past cycles, when you've seen gasoline prices rise, you've seen wages rise, especially lower income wages rise. There were a few tankers that were able to leave the Strait of Hormuz recently, and almost all of them were Chinese owned or operated. China's been a net beneficiary, relatively speaking, so I don't think they want anything to change.
Josh Young, CIO of Bison Interest, returns to the show to give us his update on oil and the global economy. And spoiler alert, Josh thinks that higher oil prices may actually be good for your real wages and for the growth of the economy. He's going to explain why and what's next. Josh is back with us with a new forecast for oil, and we'll be talking about when the Strait of Hormuz may open. This also is a trade on Kalshi, which happens to be the sponsor of today's video. Kalshi is the largest prediction market in the United States. Unlike a sportsbook, you're trading peer-to-peer on real-world events, from economic data to political outcomes. And the price moves based on public opinion, not a house. Go to the link in the description and use code LIN, link down below, or scan the QR code here. New users will get $10 when they trade $10, again, using my code LIN, LIN. For example, you can trade on when the Strait of Hormuz will return to normal. That is a trade that we are talking about with Josh today. I'll leave that on the screen. And if you put $50 down on, let's say, reopening by August 1st, for example, you may actually earn $100, $104 if that trade turns out to be correct. Once again, go to the link in the description and use code LIN. Josh, welcome back to the show. Good to see you.
Yeah, thanks for having me.
Your bullish call on oil and what's going to happen to the economy. We'll revisit that. First, I'm going to talk about Xi Jinping hosting Donald Trump in Beijing. Now, the two sides seem to be aligned on Iran. So I'll just pull this up. The Trump administration said that Xi Jinping and Trump both agree that the Strait of Hormuz needs to be open or remain open, and that a deal needs to be made soon. This is from, there's various news articles on this. This happens to be from Reuters. Trump says the U.S. and China are aligned on Iran. This is the first sentence of the article. U.S. President Donald Trump says his patience with Iran was running out, and that Chinese President Xi Jinping has agreed during their talks in Beijing that Tehran must reopen the Strait of Hormuz. Interestingly, the price of oil hasn't collapsed on this announcement, maybe because nothing's happened yet. But do you see this as a step forward on actually reopening the Strait of Hormuz? And what can the Chinese and the Americans do in terms of cooperating together to reopen the Strait of Hormuz?
Yeah, I think it's just completely bogus. So My read on this is that the Trump administration asked China to stop supplying Iran with weapons to stop shooting down our planes. And Iran agreed to stop supplying Iran with weapons and said that they've never supplied Iran with weapons. What they do supply Iran with are the precursors to these weapons, and they have not agreed to stop supplying those. So I think China benefits from a weakening U.S., and China, you can see there were a few tankers that were able to leave the Strait of Hormuz recently, and almost all of them were Chinese owned or operated tankers, and they were bringing oil and oil products to China. So China has been a net beneficiary, relatively speaking, from the current situation, both from a political power perspective, where a weakening U.S. potentially benefits China, as well as economically, where they've been a preferential receiver of either Iranian oil or oil that's been able to come out from the Strait. So I don't think they want anything to change. I don't see anything from this meeting that was indicative of any sort of progress towards ending the Iran war. I think maybe the Trump administration expected more help from China. Maybe they were surprised not to see it. And then these statements from the Trump administration, unfortunately, increasingly seem weak. And it's unclear whether the Trump administration now is going to shift back towards the U.S. engaging more militarily with Iran, or just trying to keep negotiations going. But this is not, if I were on the other side of the table from Trump and this was his negotiating position, I would think I was getting sort of more of a deal, not less of a deal, based on this fact pattern.
So as an oil investor and a portfolio manager involved in the oil space, and we will talk about oil companies in just a minute, are you investing with the assumption that the Strait of Hormuz will remain closed for the foreseeable future? In other words, are you pricing that in as a certainty, or do you think that this is transitory and you're positioned for a reopening?
So I try to be very cautious because started doing this 11 years ago for Bison when we founded the firm, and it's been very tumultuous. So we named it Bison because we face into the storm like the bison does, unlike the other animals. So for most of the portfolio, we try to be very conservative and own things that are mispriced and can survive a variety of price environments. That being said, with a portion of the portfolio, a small portion, which is sort of a risk basket, we are positioned for potential Strait remaining closed for the foreseeable future, like you described. So we're positioned to really benefit from it to the extent that continues, while also potentially surviving and thriving even if the Strait reopens tomorrow.
What does that mean? If the Strait reopens tomorrow, you'll still be thriving? I mean, wouldn't oil go down if the Strait of Hormuz opens tomorrow?
Yeah, so I think we were really worried about that for the first, let's say, few weeks of the conflict. But at this point, it's been 2.5 months that the Strait's been closed. And what that means is that as it reopens, hopefully it does reopen and hopefully it happens soon, it's going to take a number of weeks and months for the bottleneck that's been created through the Strait being closed to debottleneck. And then it's going to take a while for production to turn back on across the Persian Gulf. And most of the production should turn on fine, but some of it may not turn back on at all, or it may take months or years and huge amounts of capital and lots of services to be able to turn on. So there's sort of two ways. One, that I could benefit to the extent the Strait reopens tomorrow. One is just that the price falls for oil, but it doesn't fall nearly as much as I think people are hoping or expecting, or the Trump administration is saying. And so that I think will surprise people and potentially be beneficial for the oil equity prices. Secondarily, and maybe more importantly, I'm leaning heavily into oil field services, especially onshore drilling and related services in the US and Canada, where we're seeing the start of a boom, which may not be affected by the Strait reopening. It's sort of more of a cyclical thing that's not really driven. Obviously, it's aided and being accelerated by the Strait being closed. And those services stocks, they're very cheap and there's a lot of upside. And frankly, the Strait reopening may make people feel more comfortable to invest because there'll be less uncertainty rather than the current situation where everyone's waiting for that one tweet or Truth Social post or whatever saying the Strait is now open and then expecting a decline from that.
Okay, this is from Kaushi. It's a prediction market in the U.S. So how high will U.S. gas prices get this year? Now, you were on the show with me in early March, and you had said that if the war in Iran persists and lasts a while, we could see oil go to $200. And you got a $250 oil hat, WTI hat right behind you. The highest I think Brent has gone is 118, even with the Strait of Hormuz closed and reopening partially, it's still hovered just above $100. Why hasn't it gone to 200 yet, Josh? What's holding it back?
Yeah, so the simplest explanation is two things. One, there's a lot of oil in storage. And so every day that the Strait remains closed, there's another roughly 10 million barrels of oil that leave storage. And there's a high correlation between oil storage falling and oil prices rising. So that's one factor which has been supporting the price and which I expect to, in a nonlinear manner, affect oil prices going forward, sending them much higher, like I described previously and like I forecast previously. And then the sort of second factor is that with these sort of fake ceasefires and fake peace proposals and sort of these headlines where oil prices fall 10% in a day and then they sort of bleed back up, we've seen the volatility for oil skyrocket, and we've seen essentially the value at risk from owning one barrel or one contract of the futures for oil. We've seen that rise a lot, which essentially the way people speculate on oil generally is via CTAs or via hedge funds. And so their budgets aren't actually in dollars like you or I might invest in a stock or a commodity or whatever. Their budgets are in value at risk. So by increasing the volatility dramatically through these sort of fake news statements and these sort of one step forward, two step back sort of headlines, what we've seen is a suppression of speculation and investment in oil futures. And so that suppression has kept prices down for now. The impact of each of these headlines, like you mentioned earlier with that one headline, is diminishing. And as the volatility from those headlines diminishes, the ability for folks to speculate increases, but also the fair value rises because inventories are falling. So there's sort of this combination of suppression through narration and through sort of news control, as well as it just taking some time for inventories to fall to send prices higher. To be clear, the 250 call is not directly from the Strait of Hormuz. Like, that may be the trigger. It's more of a cyclical call that cyclicals tend to go to an all-time high inflation adjusted price at the top of each major cycle. And we've been near the bottom of the oil cycle. Maybe the bottom for it was 2020, where prices went negative. And so after setting up with a unrealistically negative price, I think we're set up for a potentially unrealistically high oil price, 250 or higher.
What was surprising to me is that I'm just using ExxonMobil as an example, but some of these large refiners and producers of oil have not outperformed the NASDAQ index since the start of the Iran war. Now, there has been a major push. Wait, I take that back. Sorry, this is not what I meant to do. It has outperformed the NASDAQ, but it hasn't outperformed a lot of the major Mag 7 stocks.
You want to do like SMH, I think, as an indicator that's like sort of a good AI.
Yeah, exactly. There we go. All right, same percentage scale. And I want to do 3 months since late February. There we go. Yeah, I mean, this as you know, the S&P and the NASDAQ have just been skyrocketing like a rocket ship, and the rotation away from tech into oil just hasn't happened. It has happened for a short period of time, and then you got the oil companies falling back down. Can you just look at this chart and explain to us what's happening here?
Yeah, so two things. So one, Exxon is materially negatively affected by the Strait of Hormuz closure, along with other oil supermajors and certain oil field services companies. And so because of that negative effect, their stock, I think, is having trouble participating with elevated oil prices. And then the price suppression in oil is keeping oil from going up as much as it likely should to reflect the supply constraint. There is one other aspect of this, which is that while there might be sort of an inverse correlation sometimes between energy stocks and other stocks and between oil and the broader stock market, when I look at this, I see essentially embedded demand. I see future demand for oil as these chips being made by these SMH companies need to get installed into data centers that don't exist yet and need to be powered in many cases by, which is very wasteful, by backup diesel power generators. And so there's just this tremendous embedded future oil demand that you're seeing when you look at SMH, which was not the case for prior technology cycles. This cycle is different. It's much more capital intensive and it's much more oil intensive. So frankly, Exxon isn't my preferred way to get exposure to this sort of thing. I prefer smaller companies that are major beneficiaries of the Strait being closed, but I also don't see technology stocks or this current sort of AI, whether it's a bubble or sort of just a real sort of super cycle for technology. I don't view that as a threat for oil. I view it actually as quite promising because I'm seeing the demand statistics and they're just phenomenal. I mean, these are potentially some of the biggest incremental demand drivers for oil over the next few years.
We'll get to the smaller names in just a minute. So the assumption that a lot of people have, which is that the S&P and the NASDAQ components will suffer because of higher oil prices. If higher oil prices are here to stay for the foreseeable future, meaning let's say the next quarter or so, margins will compress, earnings will be reduced, and you'll see a correction in the stock market. That thesis hasn't played out. Should we move on from that completely now, Josh? Should we forget about that?
Well, I just think it's complicated. I've put out stuff and my firm has put out stuff indicating that the U.S. economy actually benefits from higher oil prices. We put this out 18 months ago. Got a lot of pushback, but we did it off of the Federal Reserve paper authored by Ben Bernanke. So it wasn't like crackpot. It was like the central sort of common consensus.
Tell us about that. How does that work?
Yeah. Ben Bernanke was observing the correlation between higher oil prices and a booming U.S. economy. There's some positive circularity between higher oil prices and higher wage rates. So the sort of inflation that you actually want to see, which is people getting paid more, tends to be very highly correlated with oil prices. And then the one sort of change from when Bernanke published his paper, I think it was in 2016, and when we published ours in 2024, is that the U.S. had gone from being a net oil and oil products importer in 2016 to a net oil and oil products exporter in 2024. I think the flip was around 2021 or 2022. Might have been a little earlier than that. And so because we're a net exporter, you can do the very simple Econ Macro 101 math, which is if you sell more of something than you use, then if you're a net seller of a thing instead of a net buyer of a thing, as you sell it for a higher price, you do better. And there's a lot more complication than that, but that's just like a very simple, high level math way to understand it.
And you know what's really interesting is this, maybe this ties into what you were saying just now. Lower income consumers are getting hit the hardest by higher gas prices. So those households earning less than $40,000 a year increased gas spending by the least of all income groups. By comparison, high-income households, defined as those earning more than $125,000 a year, raised their spending by 19%, as they only cut the real gas consumption by 1%. Thus, the K-shaped consumption pattern in both a nominal and real gasoline spending was strongly evident in March 2026, say researchers. Your response to this?
That's reflective of a shock. And so certainly in a shock, poorer people do worse. They have less savings and less ability to absorb it. What you end up seeing, though, is that those people need to go work at Walmart or need to go work at Kroger or wherever that they're working, that they're making $40,000 a year or less. Those places need their workers to show up. And so they start paying them more. It takes a minute. It doesn't happen immediately upon gas prices rising. But in past cycles, when you've seen gasoline prices rise, you've seen wages rise, especially lower income wages rise. The sort of K-shaped distortion that we saw is reflective of this sort of more AI, more tech intensive economy. As you go back towards a more real economy, a more industrial and reindustrialized and a more sort of oil economy, you end up with much higher base wages and you bring up that bottom leg of the K. Again, it's very hard for people to think about and to understand because it hasn't happened recently, but it has happened intermittently over the last 150 years in bull markets for oil.
Should Americans be concerned about inflation in all goods and services? Here we have 3.8% inflation, which is the last headline CPI reading. The highest has been since 2022, late 2022. But yet, if you strip out food and energy, which is core core CPI in this case, it still remains at 2.8%, a slight uptick, but nowhere near 2022 levels. So the question is, should we be concerned that the rest of the goods that we consume will also go up in price as a result of higher gas prices? Or can we just expect gasoline and oil to continue pulling up the headline inflation numbers here?
Yeah. So again, in the short term, it's terrible. In the medium term, it's fantastic. This is the kind of inflation that we're looking for. If you look at when the Federal Reserve blinked in 2021, they started raising rates dramatically right as wages started to rise. It's the inflation that sort of the top 0.1% or whatever hate, especially, frankly, weirdly, on the political left in the US. And so it's sort of this like almost like class warfare thing where we don't let wages on a real basis rise, unfortunately, for the bottom 50%, bottom 10% of the US economy. And so this is the precursor to rising real wages. This is not materially concerning to me. In fact, I think it's actually quite the opposite. This is what you're looking for from a US perspective. Globally, there's going to be a lot of pain potentially, but from an American perspective, potentially from a Canadian perspective, certain other Western markets, certain other oil producer and energy producer markets, I think will benefit tremendously from this. And then there's just one other thing, which is that gasoline prices may actually come down a little bit here, even as oil rises, because we're in turnaround season right now for refiners. And there have been a number of refiners that have come offline, both because of fires as well as just it's the seasonal time where you have these refiners offline. And so the way to think about it simply is that we have about 10 million barrels a day of oil exports offline from the Persian Gulf, but there's only about 3 million barrels a day of refining capacity offline from the Persian Gulf. So with more oil disrupted than refining disrupted from this particular crisis, we're going to see a flip, in my view, from ultra high refining margins to lower margins and higher oil prices from lower oil prices. We've seen sort of the opposite of that so far, but as those numbers flip, due to the fundamental drivers of there being more oil offline than refining offline, you're going to see gasoline prices, at least relative to oil, fall. So there's been this surge in gasoline prices. And again, it's not where the choke point is from the Strait of Hormuz being closed. It's not where that constraint is. And you're going to see the gasoline market loosen, and you should see prices fall materially, at least relative to the price of oil, to the extent that the Strait of Hormuz remains closed.
Looking more long-term now, what will be the largest source of global primary energy consumption in 2030? Back to prediction markets, traders are predicting 57% it will remain oil. Do you agree?
Yeah, I mean, it's really, really hard to substitute. This is amazing. I didn't know this existed. That was some easy money, I think, to bet on a few months ago. Above 60%. Yeah, I don't know, but that was some easy money at 40%.
I mean, 2030 isn't that far away. Yeah, you're right. And the other options are gas and coal, solar at 5%, other renewables at 3%. Modern biofuels, nuclear at 2%. I'm surprised nuclear isn't higher. Traditional biomass, hydropower. Yeah, it doesn't look like traders on this particular platform are particularly bullish on alternatives, at least by 2030. What is your view for the long term? Yeah.
Yeah, I mean, 2030, again, that's like sort of medium term at this point, only a few years away.
Sure.
Long term, I think we need to develop alternatives. It's just a question of there being overwhelming energy demand relative to relatively constrained oil and natural gas and even coal supply. And so it's less about an environmental thing to me and more about just bringing up the quality of life from, very, very low levels in places like India and China and various other sort of frontier markets. And it's really hard to bring up those levels of quality of life without much more energy consumption. And that much more energy consumption is one of the reasons why I think oil gets to $250 a barrel at the WTI hub, because in order to get to anything close, forget an American lifestyle, you're traveling in Asia, various other places, in order to get to sort of a base quality of the middle class in many of these countries, you need much more oil consumption, and there's just not enough oil, and we're not anywhere close to that. So I think we're going to cap out from a demand perspective for oil via the price mechanism over the medium term, which means much higher prices. It's going to induce more investment, but it's also going to induce some consumption substitution.
I wonder who will remain or at least emerge as the next oil producing superpower in the world. This is from your paid Substack, Bison Insights. Major oil industry inflection, the bottom of the rig cycle is the title of this particular piece. And on my screen is an oil chart showing U.S. oil-directed drilling activity trending down, a multi-year downturn. Can you explain this trend and then help us understand the answer to my question earlier, which is, will the U.S. or any other country take the crown as the number one producer of oil in a few years?
Well, the U.S. is the number one producer, and it's likely to remain the number one producer for many years to come. And the reason is that this rig count that we're showing is inflecting. And so it's rising, and it's about to rise quite rapidly. Perhaps more rapidly than it fell in early and mid 2025. And so we're seeing it by, the quarterly conference calls and the guidance from the drilling rig companies, as well as the producers, where I was just at an oil conference by a big investment bank. And it's pretty funny. Every producer says, oh, well, we're increasing rigs 1 or 2 or 3, but all our competitors aren't. So it was just the strangest sort of set of stories that I heard.
It's interesting we're talking about this. I wonder, and of course the headline I started the interview with was that China and the U.S. have agreed that the Strait of Hormuz needs to reopen ASAP. Now, for a lot of Asian countries and Eastern European countries that depend on that strait reopening, that may be good news. But I wonder if the U.S. has an incentive to keep it closed for now, because it benefits maybe U.S. producers like we're looking at it right now. What do you think?
Yeah, I mean, sadly, the Trump administration has not been very favorable for U.S. producers of oil and natural gas on a number of fronts. So I'm not sure that they've suddenly changed their orientation to be positive towards those producers. That being said, it would be a rational sort of geopolitical and economic policy to tilt in favor of U.S. oil producers. So I would hope that they would do that, but I've seen no evidence of that, unfortunately, to support what would be, again, in my view, an economically and potentially politically rational policy.
Where does OPEC fit into the picture in 10 years' time? The UAE, as you know, just left OPEC earlier last month. And I wonder if they will remain a dominant cartel even in like the next decade.
Yeah, I think OPEC Plus is strong. I think that people sort of give them a lot of flack, which is undue. I went to visit them in February of last year, and it's just fascinating. They're very honest and open, and even you see countries leave. And so you saw Angola leave a couple years ago, and they promised to grow their oil production, and it's barely grown. And then UAE left, it looks like, for a dollar swap concern, as well as for sort of security guarantees and stuff from the US. And on leaving, they said the opposite of what Angola said. Angola said, drill, baby, drill. And UAE said, we're going to continue to help supply oil to the market on a moderate basis. They basically used the OPEC plus language on their announcement of emerging from OPEC plus. So I think they're sort of very closely affiliated still. I see no evidence of the UAE wanting to deviate from OPEC plus guidelines any more than they already have. They were already cheating by a little bit, and my expectation would be that they would continue to cheat by about the same amount as they were cheating previously.
Do you see another country leaving anytime soon, and meaning another country like the UAE whose interests may not be aligned with OPEC plus, may be better off on their own?
Well, again, I'm not sure that the UAE sees themselves as not being aligned with OPEC plus. I just see that with tourism down probably 99% in Dubai, and this sort of whole service oriented economy being essentially put on pause, them having a desperate need for a dollar swap line, and then being in the crosshairs from their now military opponent that's not too far across the strait. I think those concerns outweighed a sort of nominal membership in a group where they're sort of economically and philosophically deeply aligned. So I don't know who else will leave, but I wouldn't read too much. And this particular one has too many non sort of OPEC dissent type motivations. And again, the wording on it and the signaling around it is extremely different from Angola leaving OPEC plus, for example. And so I think when you look at that, it reads like something that they were sort of forced to do as a quid pro quo rather than something that they're doing voluntarily. And then the language, I would be shocked if they went and dumped their entire spare capacity on the market once the strait reopens.
So earlier you said that you're more positioned towards the smaller cap or these mid cap producers as opposed to the larger players. Can you explain the rationale here?
Yeah, so the smaller producers and services companies. So simply, there's a huge benefit in owning companies at a much lower valuation. So on a enterprise value to EBITDA, or enterprise value to free cash flow, or enterprise value to the amount of oil production per day, so dollars per BOE per day. So or even for the reserves in the ground. So the valuations are much, much lower on the smaller caps. And then there's an added benefit, which is that a number of the largest companies have exposure to production that's shut in right now. So because of the Strait of Hormuz being closed. So there's a big benefit if 100% of your production is in Colorado or Texas or New Mexico. You're not being forced to shut in because Iran and the US are blocking the Strait of Hormuz. You're able to sell all your oil at this high price. To the extent that prices come down after the Strait reopens, to the extent I'm wrong and they come down a lot, or to the extent they come down a little and sort of take a little while to recover, there's this benefit of getting to sell your production now in this advantaged price environment at a full price versus Exxon with, I think, something like 6% of their volume shut in because of Qatar not being able to export their LNG.
Interesting. Okay, final question, Josh, before we go today. Thank you very much. Oil at $60 versus $150 by year end. Which of these scenarios is more likely for you?
Yeah, I think oil at $150 is much more likely than $60. I think we might not see oil at $60 again until the next very bad recession. So I think 150 is in the cards. Frankly, in between now and year end, we could see oil at, like we said, 200, 250. Like there is every month that the Strait remains closed, the odds of that increase dramatically. And so it's not a linear sort of process. It's nonlinear. And so there is a risk as you go from, let's say, 1.6 billion barrels of oil and products in storage here in the US to 1.5 to 1.4, you get closer and closer to tank bottoms. And the reason that there's that nonlinearity is as you get to tank bottoms, if you don't actually have gasoline at the gas station, you stop worrying as much about getting your gas for, let's say, $5 a gallon instead of $4.90 or $5.10 from the gas station around the street. And you start worrying about getting gas so you can get to work. And so you end up with a price rationing process rather than a sort of normal supply demand process. And so when you get into that price rationing level, that's where you're getting to that 200, 250 type oil price number. And that price rationing happens because of artificial large supply constraints like the constraint that we're seeing right now with the Strait remaining closed. So inventories are depleting. The SPRs, the Strategic Petroleum Reserves, are being released right now into the market. As they deplete, as we get closer to that essentially wall, when we hit that wall, potentially you get much, much higher prices and you get those sort of 1970s style gas lines and real true availability restrictions for oil and oil products.
Okay, excellent. Thank you very much, Josh. Where can we follow you and Bison Interests?
Yeah, bisoninterest.com. You can check out my newsletter at bisoninsights.info. And David, I really appreciate you having me on.
Yeah, I really appreciate you coming back and giving us an update. And let's stay tuned to what happens next with oil and the Strait of Hormuz. We'll have you back again, Josh, to give us updates as this story progresses. Thank you very much once again. And thank you for watching. Don't forget to like, subscribe, and follow Josh in the links down below.